Hey guys, it's May from Markets with May, and in this episode, we're going to talk about 5 U.S. companies that are highly leveraged to a China reopening. While the U.S. markets and most of Europe have been highly volatile and flat to slightly down on the year, the Chinese markets have actually shown great resilience, in many cases up over 10%. And some people are figuring out different ways to get exposure. While there's a lot of great names in the Chinese market, because of what happened last year, many people are feeling a little burned. As a result, I wanted to put this list together of S&P names that were my top 5 choice here at the beginning of the year. Markets with May has had Chinese commentary for almost a year at this point. Last year, we were quite bearish going into the Chinese elections. And then there is a series of videos I did surrounding it, suggesting that afterwards would be the time to buy, but most likely surrounding Chinese New Year. Now, this video is divided into 3 parts. In the first section, I'm going to review briefly and quickly some of the things I'd said last year about China and the timing and why I felt even last year the timing would be right about now. Second, we're going to talk about the 5 U.S. companies that have significant China exposure and should be on your radar screen. And finally, I'm going to talk about other U.S. companies that have significant Chinese exposure, think industrials, that didn't make the cut and why it was that was the case. And just to be clear, this is only going to be large cap names that are components of the S&P 500, which means they fulfill some basic investability requirement. But first, I have to give the disclosures. Past performance is not indicative of future returns. This is not investment advice. This is my opinion, and this is for education purposes only. Finally, I want to give a shout out to Gurula. Money goes where it's treated best. There's details about them in my show notes. Definitely check that out. And with that, let's get into my top 5 U.S. companies that have exposure to China reopening. Now, as longtime watchers of my show know, last year, if you had any knowledge about China, you knew for sure that market was going down and not up. And that had to do with the fact that due to COVID lockdowns and the election coming in, there just wasn't going to be any kind of meaningful lift in the economy. I mean, Xi Jinping really shut it down to make sure that he could ensure a very long term for himself as the leader of China. Now, throughout last year, we talked about the fact that we weren't expecting big things from the China market until after the election finished. And then afterwards, we discussed the fact that it might take until after Chinese New Year's to really see the lift begin, with some evidence happening as we moved closer to the date. So I will post my links of the coverage that I did on the CCP National Congress. Now, we did see a series of fits and starts to reopening the economy. Unfortunately, China kept experiencing COVID issues, which is why we felt that the opening would take until potentially the end of Chinese New Year's. And now here we are at the beginning of the year with a significant rally in the Chinese stocks. And I'm telling you, I don't think it's over for a lot of different reasons. I will say that we're still not to Chinese New Year's yet, which is going to happen on January the 22nd, is that Chinese New Year's is a 15-day holiday filled with travel and oftentimes resulting in many businesses running a very low level of production and staff. So if you look at China in the first month of the year, you won't really be able to see what's happening through the normal metrics of economic data. You really have to hear it through the nature of the fundamentally changed policies that China is putting forth. Now, there have been a series of announcements that have largely gone missed in the marketplace, but the one that really launched things off at the beginning of the year was this particular news article on Ant Financial. Now, Ant Financial is a subsidiary of Alibaba, and it was supposed to IPO in 2020, but the regulators put a kibosh on that in China. This move signaled to the marketplace that China was willing to start to reopen its financial markets and had certain dedications to making sure that GDP growth happened in 2023. China's had fits and starts in reopening, but some of the news flow on the vaccine front has made a big difference as well, demonstrating a clear series of steps that China is taking to try to make progress in 2023 and open back up its economy. Now, with the rally, some folks might think they're too late to the game, but truly you are not if you really understood how beat up these companies have been. Even on the US side, the companies that I'm suggesting did get clobbered pretty hard, or alternatively, just have such ability to swing given their exposure to China. Now, I'm also going to say very clearly, I anticipate a lot of volatility until after Chinese New Year's. And a lot of that has to do with the fact that the West commonly and continuously misinterprets what's going on with Chinese New Year's. But here are the major points. Number one, most people misread the economic data because they don't understand the impact of Chinese New Year's on consumer behavior and business behavior patterns. Number two, they forget that because it's such a massive travel holiday, the Chinese government, given what it's doing in COVID, is going to behave a certain way. All of that may dissipate significantly after the Chinese New Year. Additionally, you have a ton of volatility in the US market, so you might actually still be able to pick your spots carefully in each of these 5 names. The last little thing I'm going to say before I give you the list is that I didn't put these in any particular order. They come from a host of different industries. And after you get done with your due diligence, just pick the one that you feel like is the best. The first company on the list is Pfizer, ticker PFE. Full disclosure, I am long Pfizer, but I own most of the drug companies for years at this point. Now, this Pfizer call is far more controversial than I would have thought originally. There's actually several analysts that have gone slightly negative on Pfizer, as well as an Investor Business daily article first thing this year that talks about how Pfizer is going to have to prove itself this year versus resting on its laurels. I have no idea what these people are talking about. Look at the chart for Pfizer. It did barely anything last year. I almost can see where they're coming from because you did have revenue decline year over year because they were coming up against tough revenue comps for the previous year. Over 50% of Pfizer's revenues do in fact come from COVID-related vaccines or drugs. But you did see them actually still post earnings growth because the mix was better, meaning COVID vaccines are kind of expensive and not necessarily the best margin. That said, they managed all last year to still post really good numbers relative to their competitor, Moderna. Now, this China news comes as a gift to Pfizer, which is dependent on the COVID revenues to really amp up a war chest of cash that they did actually take time during the last 2 years to buy pipeline. In other words, they bought smaller companies that had great progress on particular drugs that they felt they could distribute or otherwise speed up the process of development. And so as a result, they do have more than one drug in what they call phase 3. If they receive approval on those things, it could be another bonus for the year. That said, Pfizer around $50 trades just slightly over 7 times enterprise value to EBITDA. And you have to give Pfizer some credit and some love because unlike other healthcare companies that made most of their money on COVID in 2021, but managed to really do terribly in 2022 in comparison, Pfizer managed to post good numbers by any standards 2021 and 2022. Now, I don't want to be too mean to the analysts on the street because it absolutely is the case that Pfizer is going to have some phase 3 drugs phase on through to actual revenue and profits. But I'm feeling pretty good about some of the drugs that are on the docket, in particular the migraine drug that is in phase 3 currently. Dividend yield over 3%, you have a little bit of buffer. Pfizer is the kind of name that people do like to set it and forget it and own for life. And certainly the China business is going to buy them a bit more runway to figure some of these drugs out and get them phased on through. The second company on my list is Starbucks, ticker SBUX. Now, I own the world's smallest call position on Starbucks as a China play. It's not typically my style of investment to go in this particular company. Now, my reason for not increasing my size significantly in Starbucks has to do with valuation, which I'll get into for a second. But if we're talking about who's levered to China, Starbucks is definitely one of those companies that is. They've got about 6,000 stores out of their 35,000 that are based in China. In contrast, you can think of the U.S. as about 15,000 stores. And as far as I can tell, the management call, they're crystal clear that they'd like to make those numbers at least equal, if not slightly higher, in just China. Now, all last year, the constant closures of Chinese urban centers, which is where most of the Starbucks are located, hurt them significantly. Comp store sales were down 16% when they reported the last quarter, just off of the Chinese store. But a reopening really helps them out a lot because every time they saw a reopening in the city, the jump was significant and their average ticket selling price was higher. Now, valuation-wise, it's cheaper than it's ever been, but it's hard to say that it's cheap. It trades about 27 times enterprise value to EBITDA, which isn't bad during its normal growth trajectory. On a P basis, most people are calculating something just under 30, 29, 30. You can, however, see a ton of leverage and swing if you get that 16% comp store sales back up to normal rates and even growing beyond that. The other kind of little baby thing that makes me want to manage my size on Starbucks a little bit, coffee price volatility and the supply and demand dynamics currently in coffee do make it tough as an analyst. And I want to fully acknowledge for the bulls that a China reopening is also a greater China reopening, which means neighboring countries that also do loads of coffee like Singapore, Thailand, Korea, and Japan will also benefit. Now, the third name on my list is Este Lauder, ticker EL. Now, for the gentleman who may not know anything about Este Lauder, it's not just the brand Este Lauder. They really do own so many fragrances and so many makeup brands. And you generally place them in lower luxury to upper luxury. They'll own everything from Bobbi Brown to La Mer. Now, Estee Lauder benefits not just from a China reopening, but actually the end of the lockdowns. For whatever reason, the lockdowns in particular were having an effect on the skincare business, and that was reported in the last quarter. Asia in general currently is about 15% of the business, but has been a little bit higher in the past. Also, a China reopening doesn't just affect China, it actually affects the greater China region. And that just has to do with the unique travel patterns of the Chinese. Think duty-free on the simple side and luxury shopping travel trips. Now, Estee Lauder did have a bit of a rough quarter last quarter, and in fairness, it also does not trade very cheaply. I do not currently have a position in Estee Lauder, but depending on how it trades at the beginning of the year here, I may be putting one on. The fact is, though, you almost never get Estee Lauder on the cheap. So if it's something that you've wanted for a long time, you will want to take a look somewhere in here. The fourth name on my list is United Airlines. Now, I absolutely have positions in United Airlines, and while they have traded wildly in the last year, despite popular opinion, they are absolutely showing almost a full recovery from pre-COVID levels. Now, I've talked about this on every single call I've made as relates to airlines in the last year. There is actually a benefit for the U.S. airlines over and above other countries because we are in the U.S. an oil-producing nation. United Airlines has more leverage to Asia than any other U.S. airline. But oddly enough, the one region of international travel that has not recovered at all is Asia. In the last earnings report, you could see pretty much every region improving back to 2019 levels, in some cases even above 2019 levels.
But Asia still had 42% left to go before it reached what was happening in 2019.
Now, you might be thinking, is it really that important, this one country, to U.S. travelers? And the answer to that, oddly enough, is yes. But it's not just China reopening, but the fact that that usually results in greater travel throughout the entire region. In other words, a business person may not go to just China. They may then hop on over to Japan, Singapore, etc. Is United Airlines cheap? It kind of depends on what metric you want to focus on for valuation. On a forward earnings basis, it's trading under 7 times, which might seem cheap, except you realize they have a ton of debt. So some of that cash is not going to shareholders. It's just going to go down, improve the balance sheet, and lower interest expense. Short of that, though, this is kind of how the airlines look when they're coming out of the trough of their recoveries. So that's why I was okay, despite the debt load, to take a position on United Airlines. Now, the final name on this list is MGM Resorts, ticker MGM. Now, this is not to be confused with the theater. We're talking Vegas, baby. That's what MGM is. But it does also have all of those casinos in Macau and in the greater Asia region. Now, the last 3 years of COVID lockdown has been really annoying for this company that literally just finished building a new casino right into the COVID period. If you were to look at the financials, it does look like a hot mess. Some of it's because they just did an acquisition, so that math has to be accounted for in a particular way. Additionally, you'll see something in the disclosures and some notes about having to renegotiate with the Macanese government relates to their long-term lease on their buildings. But that'll all be in the past for people that are looking at MGM today. Macau used to be about $3 billion in revenue and about $750 million in earnings. Now, they haven't yet reported the last quarter that just happened, but in the September quarter, they really only had about $500 million coming from a business that used to really make a whole lot more. Additionally, you still don't know until the very last moment whether or not China is going to allow travel to Macau for the Chinese New Year. Now, forward earning estimates on this are all over the map. And if you just look at a Yahoo Finance to look at it, you'll see something like 50 times earnings, something like this. The enterprise value to EBITDA number looks more right to me at about 10 times enterprise value to EBITDA. This company doesn't have a lot of debt. But you know, this is a casino. This company's capitalized itself like a champ, just so you know that the house has more money than you do. Now, Vegas and the regional casinos have actually been doing better than 2019, getting more efficiencies and greater margins as they go. So you bring China back up to where it used to be, and you've got quite an interesting company to be long. Now, I am long this stock. You should absolutely do your own due diligence because, after all, it's a casino. Now, you might be asking yourself, hey, May, you missed some companies that definitely have Chinese exposure on that list, namely Albemarle on the lithium side and a bunch of the industrials that paid their bills all the way through 2020 because Chinese companies bought up their equipment or parts or whatever it might be. Well, the reason I include the industrials is you do still have a couple of unknowns as relates to how precisely the Chinese government is going to navigate the growth. Is it going to come through manufacturing? Is it going to come back through construction? You still have a little bit of Evergrande that needs to be swallowed. What's exactly going to happen? Now, we know that the Chinese government has termed out a lot of that debt. I won't go into detail on what that is, and also has attempted to support the construction industry back into where it used to be. But we don't know the speed of that yet. That's still to come. The names I recommended have less immediate unknowns. Furthermore, a lot of the staples that might benefit, they got weird Europe exposure, and they got to figure out what's going on as relates to inflation and what Latin America is going to charge us for the fact that we didn't make enough food in the Northern Hemisphere. These companies that I named, they don't have nearly as many variables to contend with. Just reopen and it should affect your income statements, balance sheets, etc., in a very particular way. So what did you think of my picks? I would love to hear if you already own some of these, if you completely disagree with my picks. If you feel like I missed something, put it down below. I'm always interested. Additionally, if you could like, share, comment, subscribe, that would be amazing. Here are some of the videos that I mentioned, the previous episodes on China, as well as previous episodes where I've gone in more detail on the names that I listed in this video. Until next time, good luck on your stock portfolio this year. Bye.